Hey everyone, I'm Neil Patel, and today I'm going to discuss 7 angel investing rules that you should follow. The first rule I have for you is invest alongside other people. You don't want to be the only check writer. See, with companies, they don't just miraculously start and do well. They need help. That help can come from you, some of the other angel investors, but the more people that are around the table, especially if you have experience in that industry, you can guide the entrepreneur, you can give them suggestions. Sometimes when you're in the business, you're in the grind, you don't always see everything clearly. So that advice that people get from their investors helps them. So when you invest alongside of other people, collectively, you can give these companies more advice, and that should help them grow even faster. The second rule I have for you is invest in a big TAM. If you don't pick a big TAM, total addressable market, and we've talked about this in some of the other videos, you're not going to do that well. You don't want to pick a company that only has the potential to get to $1 million. If that's the case, your returns aren't going to be great. You want to pick companies that have the potential to be the next $100 billion, trillion-dollar business. That's when returns look much better and the potential is there, versus your upside is capped if you're only picking these $1 million deals where their market is very tiny. The third tip I have for you is look at things as a 10-year horizon. Sure, some deals will give you a return much quicker. There's some deals where you'll get a return in less than a year or 2 years. But you want to have a 10-year horizon, because if you're trying to invest in the next SpaceX, Tesla, Apple, Google, Uber, these companies take a while to build. Now, that doesn't mean someone may not come in earlier and buy some of your shares out. I've had deals where other big investors like Naspers comes in and they say, hey, we're a big, company in South Africa, I believe, and they're a multi-billion-dollar organization. They're like, we want to buy out your shares in the company. And, with me, the money was good, the returns were amazing. I said, sure, why not? And I'm not saying that won't happen to you, but with these companies that are changing the world that you should be investing in, you need a long time horizon, because you're not going to solve big problems in a short period of time. The next rule I have for you is invest in what you know. The moment you invest in something you don't know, that's when you have greater chances of losing money. Like if someone comes to you and say, hey, I can fish gold out of the ocean and I know how, and you know nothing about gold or the ocean, that's when you're more likely to lose money, versus if you know everything about running a retirement home and you see that the retirement homes make a ton of money, and someone comes to you and be like, I have a way to modernize retirement homes and make them way more capital efficient with technology, and you can relate to them and you understand it, cool. You have better chances in stuff that you understand versus things that you don't. The next rule I have for you, the fifth rule, if it's too good to be true, it usually is. If someone's telling you that they're going to sell this company and they have buyout offers and they're ready to go and people want to, well, why do they need your money if they have all these people who are ready to buy them? Or if they have a customer who's willing to write a $100 million check to them? If that was the case, they wouldn't need your money. Again, if it sounds too good to be true, it usually is. The sixth rule I have for you is don't get too greedy. A lot of times when these companies are doing really well, other people will come in and they'll say, hey, we'll buy out your shares. And they'll give you amazing return. Like if they give you amazing return and you're happy with it, like they're giving you a 10, 20x return on your money, and that's good for you, take it. If you think, hey, this company is a sure thing and it's going to be 100, 200 times return, it could be. But you can still liquidate some of your holdings. You don't have to liquidate all of them. The reason I say this, even when a company does really well, if they start raising big sums of money, like $100 million, $200 million, what happens is the last investors have preferences in which if something wrong happens to the company, they get their money out first. And things do go wrong. It's happened many, many times. Just because something's going really well right now doesn't mean it's always going to stay that way. So don't get too greedy. And the last rule I have for you is consider doing your pro rata on the deals you love and they're having amazing traction. If some company is growing hand over fist, 10x in revenue, and they're profitable and they're growing fast, think about raising more money and you think this could be the next big Uber, then you should consider doing your pro rata, because that's how you maintain your ownership and get the highest returns, versus if you just write one check and forget it, then as other investors keep coming in, you're going to get diluted. And that's why you should consider doing your pro rata on the really good deals that have financial traction. So that's it. Follow those rules. They'll help you become a better angel investor. A recent law means that you can now be the first person to invest in the next billion-dollar company. And I've set out to teach you how you can do just that. Why me? I've been doing this for over a decade, and I've made plenty of mistakes. I want you to learn from them and recognize that you now have access to the opportunities where 95% of tech investment income is made. Click the link below to sign up for a free online event where a special guest and I will explain everything for you.